Welcome back to the channel.
This is Ian.
And this is Andra. We're so glad you're here with us today as we explore the fascinating world of China's electric vehicle giant, BYD, looking into its finances, its unique business moves, and asking, is it really as strong as it seems?
That's right. It's going to be a really interesting discussion. We've been looking into, well, quite a bit of information about BYD.
Yeah.
They've become such a massive player, haven't they? Especially in the global EV market, and particularly in China.
Absolutely. So today, we really want to unpack what's behind their success, maybe look at some business practices that, well, raise some eyebrows.
Yeah, and understand the challenges they're facing too, and kind of figure out what the research suggests about whether this rapid rise is, built on solid ground, or if there might be some hidden issues.
Okay, let's get into it. First off, you really can't talk EVs, especially in China, without BYD coming up immediately. Their dominance there is just huge.
It really is.
Yeah.
I saw some numbers suggesting Chinese brands now hold something like, 76% of the market share for what they call new energy vehicles, NEVs, in China.
Wow, 76%?
Yeah, it's a massive slice, and BYD is definitely leading that path.
And the sheer growth of NEVs there has been, well, explosive seems like the right word. The data I came across was kind of wild, like from about 2.6 million NEVs on the road in 2018.
Okay.
That number jumped to over 10 million by June 2022.
10 million. That's incredible growth.
And the vast majority, something like 81%, are pure electric vehicles.
And you need the infrastructure for that kind of adoption, so charging stations.
Right, that's grown massively too. Charging piles went from around 777,000 back in 2018 to nearly 5 million by 2022.
Okay, that makes sense. You need places to plug all those cars in.
What's really interesting, though, is that China actually phased out its national NEV subsidies near the end of 2022.
Oh, right. You'd maybe expect growth to slow down then.
You might think so, but apparently the market just kept booming right after that. It didn't really miss a beat.
So that suggests it's not just subsidies driving it anymore. It's real consumer demand.
Exactly. It seems like a big shift. So the question is, how does a company like BYD not just ride this wave, but actually dominate it? And that, I think, brings us to their finances.
Yeah, their financial engine. From the outside, looking at the reports, they look incredibly strong. Profitability, revenue growth, it all seems really impressive.
The numbers for Q1 2025, for instance. Net income apparently doubled compared to the year before, hitting about 9.15 billion RMB.
Which is roughly, what, $1.26 billion US? That's significant profit for one quarter.
And for the full year 2024, net income was up a solid 34%. Usually that signals pretty sound financial health, and they generally have a BBB credit rating, which is seen as stable, right?
Right. BBB is investment grade, considered pretty solid. Here's where it gets maybe a bit more complex and maybe a little confusing if you just glance at the balance sheet.
You mean the debt figure? Because you might say a large total debt number and think, hang on a second.
Exactly. That's a critical point, and something I saw highlighted in an article called BYD and Evergrande, a false comparison. It really gigs into this.
Okay, what does it say?
It explains that this big debt number isn't what you might typically think of as debt, like massive bank loans racking up interest. It's actually predominantly interest-free liabilities, money owed to suppliers.
Ah, okay. So trade payables, essentially. Money they owe for parts and materials.
Precisely. That article pointed out that the traditional high-interest kind of debt is actually a really small part of their total liabilities, only around 4.9%, it said.
Only 4.9%. Wow, so the vast majority is this money owed to suppliers.
Yeah. And what's fascinating is how this structure is presented, not as a weakness, which you might expect with the word debt, but as a major strategic advantage for BYD.
How so?
It's almost like they're getting a massive interest-free loan from their entire supply chain. This frees up a huge amount of cash flow and working capital,
which they can then pour back into the business. R&D, building new factories, that kind of thing.
Exactly. Reinvestment without having to pay interest costs on that capital. It's a powerful tool.
Okay, so how do they actually manage that? How do they get suppliers to essentially provide interest-free financing? That seems like it leads us into their business strategies, what some sources called their secret sauce.
It does.
Yeah.
And one of the most discussed elements is their, extended supplier payment terms.
Extended how?
Some research indicated that the average time BYD took to pay its suppliers was around 275 days in 2023.
275 days? That's That's nearly 9 months.
Yeah, and apparently that number has actually gone up in recent years.
9 months, seriously. I mean, if you ran a business supplying parts, waiting 9 months to get paid, that would be incredibly stressful. How does that work for the suppliers?
Well, there's apparently a mechanism. Reports suggest suppliers can get paid earlier, but there's a catch.
What's the catch?
They have to agree to take a discount on their invoice if they want the money sooner. It's a form of what's called reverse factoring or supply chain financing.
Okay. So BYD benefits either way. They either get 9 months of free financing or they get a discount on the parts if the supplier needs cash quickly. That's quite aggressive.
It is. And the strategic reasons are pretty clear from BYD's perspective. It boosts their working capital, gives them huge bargaining power as a major buyer.
Gets them direct cost reductions through those discounts.
Exactly. And improves their overall financial efficiency because they don't need to borrow as much traditionally, which costs money.
Okay, I definitely see the upside for BYD. It's a smart financial move for them. But what about the suppliers, especially smaller companies? What's the impact?
That's the other side of the coin. It can definitely put a huge strain on their cash flow, waiting that long. It eats into their profit margins if they take the discount.
And it probably makes them incredibly dependent on BYD's business. Losing that contract after accepting those terms would be devastating.
For sure. Sources describe it as aggressive, definitely. But they also point out it's often legal, and it's actually part of a wider trend in certain industries in China. It's not unique only to BYD.
Interesting. Okay, so beyond these payment terms, what else is part of their strategy? Vertical integration comes up a lot.
Oh yeah, massively. They build a huge percentage of their own components.
Like, what sort of percentage?
Sources suggest it's around 75% of the components that go into their vehicles. We're talking really critical stuff: batteries, semiconductors, electric motors.
75% in-house. That gives them incredible control, doesn't it?
Totally. Less reliance on outside suppliers, which probably gives them more leverage in negotiating terms with the suppliers they do use. Plus, they control costs and quality much more directly.
And speaking of building things in-house, their battery tech is always mentioned as a core strength. That Blade battery they launched.
Right. The Blade battery came out in 2020. Sources say it was a big step forward, improved safety, longer life, lower production costs, and importantly, better vehicle range.
And they're not just using them in their own cars, right? They're a major battery supplier globally.
Yeah. They hold a significant chunk of the global battery market share, something close to 10%.
Okay. Now, when you hear about a huge Chinese company, big debt figure on the books, these aggressive supplier payment terms, it's maybe natural for some people to think about, well, Evergrande, the real estate giant that collapsed so spectacularly.
That comparison definitely comes up. I saw explicitly tackled in that article I mentioned, BYD and Evergrande, a false comparison. It argues pretty strongly that comparing them is misleading.
Even though there's that surface similarity with the supplier payments?
Exactly. The article stresses that while both used extended payment terms, the context and the reasons were fundamentally different.
How so?
Crucially different. Evergrande, the analysis argues, was using supplier delays basically out of desperation. They were trying to fund this massive, rapid expansion without enough cash coming in from profitable projects.
Their core real estate business was struggling.
Yeah, it was becoming inherently unprofitable in that market environment.
Right.
So as things got worse, they often just couldn't pay suppliers at all. They didn't have the money.
Plus, Evergrande was loaded up with massive amounts of traditional high-interest debt, right? Bank loans, bonds.
Exactly. Unsustainable levels of it. And their assets, like half-finished apartment buildings, were very illiquid, hard to sell quickly for cash.
Okay, so how does BYD contrast with that picture, according to the analysis?
Well, as we discussed, BYD uses the supplier term strategically to manage working capital from a position of strength. They are critically highly profitable. They generate strong cash flow from actually selling millions of cars and batteries.
So fundamentally, they can pay their bills. They just structure it to pay later.
That's the argument. And their debt is mostly that interest-free supplier liability, not high-interest bank debt. Their assets finish cars, components are generally more liquid.
Right. So while the payment practice might look similar on the surface, the underlying financial health and the strategic intent are presented as being worlds apart.
Exactly. One was seen as a strategic choice from a profitable company, the other a desperate measure by an unprofitable one spiraling into insolvency. It's a really key distinction according to that source.
Okay, that makes sense. But that doesn't mean BYD has no challenges or risks, right?
Oh, definitely not.
Oh.
Far from it. Actually, I came across some financial analysis using something called the Z-score model.
This is C-score. What's that in simple terms?
You can basically think of it as like an early warning system. It
Yeah.
uses certain financial ratios from a company's books to try and predict the likelihood of it going bankrupt within, say, the next couple of years.
Okay, a bankruptcy predictor. And what did this analysis find for BYD?
Well, this specific analysis, using data from 2021 through 2023, found that BYD's Z-score actually fell quite significantly. It went from 3.36 in 2021, which is considered pretty low risk,
Right.
down to 1.67 in 2023.
1.67, is that bad?
According to the thresholds used by that particular model, yeah. A score below 1.81 is often interpreted as indicating an extremely high likelihood of bankruptcy.
Wow. Okay, that sounds pretty alarming, especially after hearing about their doubled profits in early 2025.
It does, and this is where things get really complex, right? How do you reconcile that kind of warning signal from a specific risk model using data up to the end of 2023?
With the fact that they just reported record profits a year later.
Exactly. It really highlights that different analyses looking at different metrics like risk indicators versus current profitability and using different time periods can give you very different pictures.
So it suggests the situation is maybe nuanced, or perhaps things changed quite rapidly between the end of 2023 and early 2025, or maybe the model itself has limitations.
It could be any or all of those things. It suggests things are complex. But it does point to potential underlying vulnerabilities, even if current profits look good.
Okay, so putting aside that specific Z-score result for a moment, what other pressures are highlighted in the sources? What might be causing that kind of risk indicator?
Well, market competition is a big one. The EV market in China is incredibly crowded. You've got Tesla, obviously, but also strong local players like NIO, Li Auto, XPeng,
Yeah.
and now even tech companies like Xiaomi getting in.
Plus all the traditional car makers trying to switch to electric.
Exactly. It's intense. And then there are the ongoing supply chain pressures. We hear about this all the time. Price swings, potential shortages for key things like computer chips or raw materials for batteries, lithium, cobalt, nickel.
Keeping those supply lines running smoothly and affordably must be a constant headache.
For sure. And then there's the brand image aspect. I saw a SWOT analysis, strengths, weaknesses, opportunities, threats.
Right. What did it say about weaknesses?
It suggested that maybe some of BYD's earlier history, perhaps involving imitating other designs, still impacts their brand image negatively to some extent.
Mm-hmm.
And it also noted that while their production scale is huge, their systems might not yet be perceived as quite robust enough to compete effectively in the really high-end luxury EV segment.
Okay. And then there's this whole other area of regulatory scrutiny, something about zero-mileage used cars.
Yeah, that sounds really odd, doesn't it? Zero-mileage used cars.
What even is that?
Apparently, it's a practice where brand new cars, literally just off the factory line, are immediately registered and then instantly sold as used cars, even though they have basically 0 miles on them.
Huh. Why would anyone do that? What's the point?
Well, the report suggests several potential reasons for this trend, which sources say involves BYD among other automakers. One idea is it could artificially inflate the reported new car sales figures.
Ah, okay. Boost the numbers.
Or it could be a way to clear out excess inventory if they've built too many cars, or maybe take advantage of certain incentives or cost structures tied to used car sales instead of new ones. Perhaps even trying to get around the initial big drop in value, the depreciation that new cars usually face.
And this has caught the eye of regulators.
It seems so. Very recently, actually. On May 27th, reports indicate China's Ministry of Commerce called in major automakers, including BYD, to talk about this exact practice.
What were the concerns?
Things like market distortion, a lack of transparency for consumers, and potentially unfair competition.
And did this have any market impact?
Apparently, yes. Reports mention that the share prices of the automakers involved took a hit after that news came out. So investors are clearly watching these regulatory issues closely.
Okay, so market pressures, potential brand image issues, regulatory scrutiny, and then there are also some really serious reports concerning labor practices.
Yeah, this is another significant area. A major lawsuit was filed very recently, also around May 27th, this time in Brazil. It relates to the construction of a BYD plant there.
What are the allegations?
They're extremely serious. The lawsuit is for a large sum, around $45 million US, and alleges major labor law violations by a contractor company named Xinjiang working on the site. The claims include things like human trafficking and what the lawsuit terms slavery-like conditions. Yeah, it mentions things like workers brought in on irregular visas, facing harsh treatment, and allegedly having their passports withheld.
Those are incredibly disturbing allegations. Has BYD responded?
Yes, sources state that both BYD and the contractor Jin Jiang have denied these claims, calling them part of a smear campaign. But the existence of such serious allegations in a formal lawsuit is definitely a major point of concern.
And was that the only labor issue mentioned?
No, there was also a separate account I read from a source describing the experience of a female worker in China. She alleged she faced sexual harassment, was then demoted to janitorial duties, and later illegally fired after she tried to pursue labor arbitration.
And what about the union in that case?
That particular account claimed the union remained silent throughout her ordeal.
Hmm. And were there broader governance concerns raised?
I did see a governance assessment report mentioned that suggested BYD lacks public disclosure about carrying out human rights risk assessments within its supply chain, which, is an area of increasing focus for big global companies.
Okay, so it's definitely a complex picture. You have this booming market, impressive profits, but also these potential financial warning signs, depending on the model, controversial but strategic business methods, intense competition, regulatory heat, and these very serious social and labor concerns.
Exactly. It's a lot to navigate.
So looking forward, what do the sources suggest? What are the recommendations for BYD and maybe the industry overall to handle all this?
For BYD specifically, the advice seems to be keep doubling down on technology, especially battery development. Maintain that research focus. Really understand what customers want and need.
Makes sense. What else?
Enhance their financial monitoring. Maybe keep a closer eye on those risk indicators. Perhaps diversify investments, but stick to related areas like advanced batteries, intelligent driving tech, vehicle services. Strengthen cash flow management. Maybe that involves revisiting those supplier payment terms. And conduct regular internal audits.
And for the wider EV industry in China?
The suggestions include focusing on delivering good value, especially now that those national subsidies are gone. Also, working to build public trust and acceptance of NEVs. Exploring international markets is mentioned too.
Like through initiatives such as the Belt and Road?
Potentially, yeah.
Yeah.
And the overarching message seems to be that continuous research and development, real innovation, is absolutely critical for survival and success in this incredibly competitive space.
So if we try to pull all these threads together, despite the risks, despite the aggressive, sometimes controversial practices, the analysis we looked at seems to conclude that BYD's core profitability, that unique debt structure focused on suppliers, and their deep vertical integration really do differentiate them from truly troubled companies like Evergrande was.
That seemed to be the takeaway from some sources. Yes, they are undeniably a powerful market leader right now. But as we've laid out, they're absolutely facing ongoing, significant challenges, competition, regulation, and these important social and ethical questions that need addressing.
Which really leaves us with something for you, the listener, to mull over.
Considering BYD's incredible growth story, these really strategic but definitely controversial business tactics like the super long payment terms, those mixed signals from financial indicators, strong profits, but also those risk flags and these recent serious labor and regulatory challenges.
Is their rapid growth model truly sustainable for the long haul? Or are there perhaps unseen vulnerabilities lurking just beneath that shiny surface that could cause problems down the road?
Well, that was a really fascinating look into BYD, China's EV giant. So much to think about there.
Absolutely. And that wraps up our discussion for today here on This Is Ian. What part did you find most interesting? We'd love to hear your thoughts in the comments below.
Definitely. And if you enjoyed this discussion and want to help us create even better content, please do hit that like button, subscribe to This Is Ian, and share your comments. Your engagement really helps the channel grow and tells us what you want to see more of.
Couldn't have said it better. Until next time, everyone, stay curious.